Hello, everyone. Welcome to our Andersen Tax 101 webinar. Today, we were going to present on the capital gain plannings. My name is Philip. I am a partner from our Calgary office, focusing on international private client service. Joining me today would be Franko, our new director.
Hey, good morning, Philip, and good morning to everybody in the webinar, all the participants. Thanks for joining us. As Philip said, my name is Franko. I'm a tax director with Andersen LLP, also in the Calgary office. Hope you enjoy the presentation.
Yeah, so before the webinar start, we're going over some of the housekeeping items. As part of our new webinar, we are qualified under the NASPA to provide CPE, continuing professional education for US CPA and CPD for Canadian CPAs. For those that want to get the CPE credit, you would have to stay with throughout the presentation and then answer 3 polling questions. And then also during the presentation, feel free to ask questions to the checkbox. We have 2 panelists from Shan and Kenneth that monitoring the question and address those questions accordingly. And then at the end of the presentation, we would have 10 minutes to address some of those questions. In case we could not answer all of them, we will reach out to set up a separate time to answer them. And then after the presentation wrap up, you will receive a short survey in terms of collecting feedback on how we're doing this presentation and any future topic that you are interested in. Last but not least, this presentation have the live transcript function. Please make sure you click the CC button to turn it on. Then we're going to address the agenda today. That, as some of you may know, that as of last month, the Canadian government proposed some tax change to the Canadian tax on any capital gain tax. So we are going to go over some of what's the proposed change, tax impact on the Canadian side. And then the majority of our presentation would be focusing on some planning ideas and some of the issues that you should consider. And then to wrap it up, we would provide some recommendation in terms of what to consider for any taxpayer that want to recognize any capital gain or have any question related to the capital gain taxations. So first, we would have Dale to go over some of the proposed change for us.
Yeah, so before I begin, I'd just like to apologize for the lack of the cool background like Philip has. We had some technical issues. Maybe it's because I'm the new guy. I don't know. But anyway, we apologize for that. It looks a little weird. But the fact is, or the important thing is, I think, is that we're able to pull off the presentation. So back to the proposed changes. As everyone I'm sure knows, on April 16th, 2024, the federal government came out with a budget. And the budget proposes to increase the inclusion rate for capital gains realized on or after June 25th of 2024 to 2/3. So as you know, the current rate is a 50% inclusion. So the proposed increase from 50% to 2/3 will take effect presumably on or after June 25th, 2024. I heard on the news last week that this proposed increase from 50% to 2/3 will generate $19.4 billion over the next 5 years. That's what the government is forecasted to raise in additional tax revenue, $19.4 billion, which is a significant amount of capital to pull out of the economy. One good thing, if there can be a good thing with the proposed inclusion rate, is there's an annual allowance proposed for individuals of $250,000. So what that means is the first $250,000 of capital gains would be taxed at 50% inclusion rate. Anything in excess on an annual basis for an individual would be taxed at the 2/3. That said, there's no annual allowance for corporations or trusts. And one thing to note that with respect to corporations and private corporations, the non-taxable portion of a capital gain that's added to the capital dividend account will now be 1/3 as opposed to 50%. So we have to keep that in mind as well when we're looking at transactions, capital gains transactions on a fully diluted basis, or distributed basis, I should say. So the history of the inclusion rate, for the youngsters out there, prior to 1972, capital gains were not taxed. Then in 1972, December 31, 1971, there became V-Day value, and then going forward, capital gains were taxed at a 50% inclusion rate. 1988 to 1989, that rate was adjusted to 2/3. 1990 to 1999, we had 3/4. And then back to in 2000 to 2024, the inclusion rate went back to 1/2, which is great. And now we're at 2024, being June 25th, 2024. The proposed inclusion rate is to increase to 2/3.
So that is kind of a quick observation. Seems the trend's is starting from 1/2, go to 2/3, go even higher to 3/4, and then reverse order going back down to 1/2 and 2/3. Seems it's going back and forth.
Yeah, and I think it's really just depending on, looking for a source of additional tax revenue. I think it was in the proposed budget that this increase in the inclusion rate will only impact like 0.13% of taxpayers in Canada, which I find is a little unusual, because I think there's a lot more taxpayers in Canada that have that realize taxable capital gains. And maybe it's not on an annual basis, but certainly, over this 5-year proposed period. So I think they need to find a source of revenue, because obviously in the budget that was proposed, it's a heavily fiscally expensive budget, and the money has to come from somewhere. The federal government took the position that they felt that they're asking the wealthy to pay their fair share. I don't recall anyone asking. I think it was more of a voluntold. But that said, it's a 19.4 billion increase in revenues. Who knows if that's going to happen? And further, who knows what's going to happen to the actual legislation when it's finally receives royal assent.
Yeah, like any other tax change, there were a lot of political opinion related to it. I think for this webinar, we try to focusing on just the tax impacts.
Correct. So the Canadian tax impacts for individuals across Canada is for individuals anywhere from 8 to 9% increase on that on the capital gain. For corporations, it's 8 to 11%. From an Alberta corporation at the general rate. Currently, we're about the 23% general rate. We're about 26% effective tax rate on capital gains on a fully distributed basis. That's probably going to change to about 37%. So an increase of 11% is noted there. But as we've also noted, there's a higher refundable tax for CCPCs, and as I previously said, a smaller increase in the capital dividend account for the non-taxable portion of the capital gain realized by a corporation. So hopefully everyone was paying attention, because this is a tricky question. So polling question number 1, when is the new capital gain inclusion rate supposed to be effective? And you have to pick one of the 4. So is it January 1, 2025? Is it June 25th, 2024? Is it January 1, 2024, or June 24th, 2024?
So there seems like even though the government is proposing a certain day, there was some discussion whether the date could be potentially changed as well, right?
That's correct. CPA Canada forwarded a document to the government suggesting that the effective implementation of the capital gains inclusion rate be delayed so that it ties in with the calendar year.
Okay, so we get the answer of our polling question number 1. Majority of our audience get the right answer, June 25th of 2024. Some pick June 24 2024. The correct answer is June 25th, 2024. And
Yeah.
like Dell has mentioned that CPA Canada tried to push the effective date to a later date as of January 1st, 2025 to make sure that the 2024 tax year is easier to track. So you don't have two different tax rate for different period of the year.
And please note that it's effective on or after June 25th, 2024. So if you have somebody who had, for example, some accrued gains in stocks that they wanted to, dispose of prior to June 25th, note that it takes probably 2 days to close those transactions. So if you, tried to call your broker on June 24th and said, hey, sell these stocks with accrued gains, you're going to be in the post June 25th era if it takes 2 days to close. So planning is important. Timing is extremely important.
Yeah, and Dale, you brought up a good point. In case you want to do take any action with certain tax planning idea on mine, you don't want to save it until the last day. You want to give it a little bit more time to make sure that you're on the safer side. So that would be a great segue into our planning ideas. So now everyone knows there was the impact on tax, right? Then what would be some of the planning idea taxpayer could utilize to either recognize the gain earlier or try to play with the timing, and there was other mechanism to allow you to trigger the gain without actual selling the asset. We have summarized a few different ideas. The first three is pretty much could be categorized as kind of crystallizing some of the gain or realizing some of the gain that you already have by either selling it or gifting it away or put it into some sort of corporate reorganization transactions. We would go over more details of any of the all of those planning idea in future slides. Then the fourth one is involving if you already going to recognize the gain, some of the tax law that is allow you to utilize the capital gain reserve to recognize the gain in a longer period than just 1 year to spread out the capital gain implication and potentially utilize the $250,000 allowance for an individual taxpayer. The next one is more extreme, like if you are so upset with all the tax law change, either politics or just cannot get comfortable paying that such a high tax, departing from Canada could be a solution too. And then last but not least, instead of recognizing all the gain right now and try to pay the tax, you go totally the other direction of deferring it. Hopefully, whatever the tax you pay or you avoid paying now would generate a higher return to potentially cover the extra tax that might be payable 10, 15, 20, 30 years from now. Given how much the interest rate is currently sitting at, there was a high chance that you could get a much better result in terms of time value of cash. So this is kind of a general discussion about the planning idea. Then we move on to a more specific discussion on every one of them. So the first one that most people come to mind is likely, hey, now capital gain tax rate is going high. I'm planning to sell certain property down the road. I would be caught by the higher tax rate. Should I even sell it earlier? Right. The quick answer is yes. If you plan, let's say if you plan to sell the property in July that have $500,000 of gain, if you could find a buyer in the month of June, you want to make sure that, like they'll have suggested too, you want to make sure the closing is early enough before June 25th. And then now you suddenly save 8 to 9% of any capital gain you're going to realize. Right? On a $500,000, it works out to close to $40,000 to $45,000. Even you have to provide discount to the buyer, that might be worth thinking. So this would be the most direct method because you are basically selling the asset. You don't have to worry about all the other tax laws that you have to utilize in terms of either recognizing the gain, but by doing certain election, you don't have to worry about gifting. Essentially what you're doing, you basically lock in the gain. Any appreciation up to the day, you realize that you pay tax on it. one of the good benefit that not many people thought about is you're also matching the timing of taxation for any foreign countries. Depending on the asset or the citizenship or immigration status, some of our audience may be subject to a taxation in a foreign country. For example, if you're owning a US cottage that has significant amount of gain, by selling that cottage, you would be subject to both US taxation and Canadian taxation. So by selling it, it would be a taxable event in both Canada and US. The timing is the same. Foreign tax credit is allowed on your Canadian return. So you don't have the risk of being double taxed on the same transaction or same property. You could see that in some of the future planning idea that could be potentially a drawback. And also, since now you are selling your asset for either cash consideration, then you would have the cash necessary to pay the tax. So you are not going to run into a problem of also some of the planning idea in the future slides that you recognize the gain, but you really don't receive any cash. Now you have to come up with your own cash to pay any tax that is related to that transactions. And this one also, because now you are having the cash, let's assume that the asset is, you have a lot of potential. Then you could go back onto the open market and reacquire the same asset. Saying that though, you have to realize that even you're acquiring the same asset, you are not going to have the same amount of capital invest because a portion of it basically go to the Canada Revenue Agency as a payment of tax. So if you pay 20%, you only have 80% left in terms of position in the same asset. So that would be impacting your long-term growth on the same investments. There was also some that's one of the potential drawback. The other drawback is now you prepay tax. You presumably you don't need that cash. You want it to keep growing as long as you can. But by selling the asset right now, you're prepaying tax. Regardless whether how the tax law would change, whether you would when you would need the cash. Now, either way, you already prepaid the tax. Canada Revenue Agency already collected the tax, and then you are forced to kind of paying tax and realize a gain ahead of the schedule. That's also the drawback because now you have to pay tax. You could not have the same amount of capital stay invested. So your future growth on that portion is basically gone. So that's kind of the first planning idea.
And Philip, one thing to note with that, so say it's a portfolio investment with accrued gains and you're doing an actual disposition. Not only are you locking in the gain at the 50% inclusion rate, but you're locking in the fair market value of that stock. So if you don't reacquire that same stock, you have locked in that fair market value. And if I ask my investment advisor, will the value be higher next year? The answer always is yes. So I've just taken a bit of a haircut by doing a disposition now, as opposed to potentially waiting till later. So, if your crystal ball works better than mine, then, please go ahead and see if you can perhaps do better on an after-tax basis with a higher inclusion rate.
Yeah, there was, I think that you bring up a good point. There was always some uncertainty, right? Like investment, tax, nobody know exactly what the future would be. Otherwise, we are not going to sit here and listening to our webinar because we just do based on what we know for the future. I think one of the potential risks of locking in the gain right now is, for example, if you invest in a stock, right now it might be the peak. And then if you sell it, realize the gain, even you would invest back into the same stock, the value could go down.
Right.
And then some of the capital loss, you potentially could be carried back, but depending on your nationality, like for the US, like it's tougher to kind of manage the gain whenever you are not actually need those cash. So this one is kind of reactive based on tax policy. Is impacted by tax for your investment decision. It's never a perfect idea. We want to stick to investment decision based on investment strategy only.
Right, and as we've always been instructed, as tax advisors, Rule number one, minimize tax. Rule number two, defer the tax. Obviously, in this case, we're not deferring tax.
Yeah, it's just a trade-off, right?
Yeah.
If you know that you defer the tax, that's going to be double what you're paying right now, then you have to think about it whether it's worth deferring or not, right? I think we are running into the exact same problem as if you're only going to defer it for 2 years, but you know the tax rate on it is 50% higher, then likely it's tough for you to get enough return on your deferrals.
Right.
So that's the first strategy. The other one is not as obvious, that you could potentially gift the asset. For this idea, we're utilizing the idea in the income tax law that by gifting asset to another person that is not your spouse, you essentially deem to dispose the asset at fair market value when the gift happens. So this strategy works well when you have an asset that it's kind of unique. Let's say you want to pass on to your future generation within the family. If you sell it, it's not easily for you to require it again. Then that could be an option for you to gift it to another person. So you recognize the gain, you're locking in the gain accrue up today, but you still maintain that asset within the family. This is the general rules, but in case that you want to gift it to your spouse, by default, the deemed disposition would not happen. So you basically roll the property into your spouse at cost. You need to elect out of the rollover at cost and then trigger the deemed disposition to make sure that the gain would be taxed. Because again, our planning idea essentially is try to recognize the gain before June 25th, right? If the property roll at cost, it kind of defeat that purpose. Another opportunity is transfer to an irrevocable trust. That involve even more complicated setup that you would set up the trust, transfer the property into revocable trust, presumably having your family being beneficiary. You are deemed to dispose the asset as well. Then we're adding to some of the foreign country implications. Like I alluded earlier, that a lot of our audience have some sort of foreign tax implications. 2 points that we specifically point out is in the setting of a U.S. real estate. The quick and easy answer is if you are thinking about gifting a U.S. real estate, it's really not a good idea for a few different reasons. We discussed on the Canadian tax implication that the real property would be deemed disposed, any gain would be taxable on the Canadian return. However, because we are dealing with a U.S. real property, U.S. also have tax authority to tax any income on it. And for U.S. tax purpose, whenever you're gifting an asset, it is not deemed disposed by the transfer law. And whoever the donee, whoever the recipient of the property, it would inherit the original cost base. So let's say that your son inherited this or received this property and sell it down the road for the same value as this right now, he would be taxed on the gain for U.S. tax purpose, while you already pay tax on the same property for Canadian tax purpose. And now you could see the problem is we have two different taxpayer paying tax to different country for the same gain. And there was no foreign tax credit available for you to offset each other. So the same gain being taxed twice. And that's not the end of the story. In contrast to Canada, US have the concept of gift tax. So whenever even a non-US person gifting US cited asset or tangible property located in the US, if the gift is over the annual gift exemption, currently is sitting at $17,000, the excess portion would be subject to US gift tax that could be up to 40% on the fair market value. So let's assume the real property worth $1 million, you certainly have to pay $400,000 to IRS because you gifted away to your son. So by adding up those, Canadian income tax rate, US income tax, US gift tax, the tax rate is almost as close to the fair market value, actually, right? If it's close to 90% of the fair market value, then obviously this is not a good planning idea in terms of just try to avoid the 8 to 9% increase in terms of capital gain.
One thing to note, Philip, too, with respect to spouses and electing out of the roll, the automatic rollover rules in 70 sub 6, you need to watch any attribution. So, for example, if there was a prescribed rate promissory note that was provided as consideration, you need to watch the attribution rules as well as electing out of the rollover.
Yeah, good point. I think Dell, for this kind of idea in terms of gifting the asset, it works only for a really specific kind of set of facts. Right. Only I would suggest that I would only entertain to this particular planning idea if I know that it's not going to be double tax, and I know that the assets would like to be kept within the family. Right. If you could easily acquire something similar, then selling the property or selling the assets likely a better option. You avoid a lot of things that you have to consider. And also, if we don't consider all the perspective related to this plan, it could backfire. Last but not least, for this planning idea, because now you recognize the gain for Canadian tax purpose, you have to pay tax on it. The problem becomes you only gifted away the property without receiving any cash. So now you have to come up with your own cash to pay any tax come next April when you file your Canadian tax return. So we going into the second polling questions. This one is an easy one to see whether our audience is paying attention. So what is the inclusion ratio for Mr. Smith that has $200,000 capital gain after June 25th, 2024? Let's assume that 200,000 is the total capital gain. And A is 2/3, B is 1/2, and C is 100%. So Dale, I think in this question, there are a few key important points, right? Mr. Smith is an individual, and then we talk about it's 200,000. So there was some implication related to the amount. And then the day is June 25th, after June 25th.
Right. Those are the three key, considerations with respect to the question. One, it's an individual. Two, the annual capital gain is $200,000 and it's post June 25th.
Okay, so this one comparing to the first polling question, we do have a split answer. About 1/3 of our audience think is A. About 2/3 is 1/2. The correct answer is 1/2 is B. The reason is, as we have discussed, in this case, it's for an individual and only have $200,000 of capital gain. We discussed earlier for an individual, for the first $250,000, the inclusion ratio stayed the same at 1/2. The 2/3 inclusion ratio only applied to any capital gain in excess of $250,000, regardless of the time. So after June 25th, the new rules, but still you have to be over $250,000. So that summarizes some of the idea about crystallizing or locking the capital gain. Dale is going to discuss the capital gain reserve planning idea that we could use.
Yeah, so one of the ideas is utilizing a capital gains reserve. So let's say, for example, you have an asset today, capital property with a value of $1.5 million. And if you wanted to trigger that gain at the 50% inclusion rate, the planning would be to structure the transaction so you can utilize a capital gain reserve. In other words, spreading the capital gain over multiple years. So let's say, for example, in our example, we take a promissory note with proceeds that are not due over the next 4 years. We spread the gain over 5. So if we take 4 years of claiming the capital gains reserve and bringing that capital gain into income over the next 4 years, we could do $250,000 a year for an individual, which is $1 million, which would mean backing into a disposition prior to June 25th, 2024, we would have a $500,000 capital gain at the 50% inclusion today. And then because the next 4 years is maxed at 250,000, again, 50% inclusion rate. So effectively, we've got a disposition, a capital gain at $1.5 million, for example, and it's all being taxed at the 50% inclusion rate. But you have to be careful with planning around capital gains reserve. As I said, the proceeds must not be due. And I've seen many transactions where they'll term out a P note over 5 years, but have a due on demand. And that just doesn't fly in respect of meeting the requirements of the capital gains reserve. Other things to be cautious or cognizant about is it cannot be a non-resident during the year or the year following. So if you have someone who's going to be departing Canada, you can't take a capital gains reserve. And also in respect of dispositions to controlled corporations or partnerships with the majority interest partner. Capital gains reserve are similar to U.S. installment sales, but Philip, I'll let you speak to that one, please.
Yeah, for sure, Dale. There was another potential benefit for capital gain reserve is it related to the time value of cash. If you could pay the tax, the same amount of tax, let's say all the gain that you claim in the future is still subject to the 1/2 inclusion ratio, but you could defer it for 4 more years, then you could invest those money otherwise would payable currently. That would be another benefit that not every taxpayer has thought about. Like Dale have suggested, in the US, they have similar idea called US installment sale, which have a little bit more flexibility. You don't have to recognize all the gain within the 5-year period of time. It's mostly, it's going to be calculated based on the proceed received during the year, divided by the total proceed. But since we are going to plan to use both capital gain reserve for Canadian tax and then installment sale for US tax, then ideally we want to match the timing and the amount of gain recognized in any specific years, for the reason that now we are matching the timing of the taxation, we are matching the income of taxation. So in case the gain is subject to both Canadian and US tax happen at the same time, foreign tax credit could be claimed. So no double taxations.
So the other option is corporate reorganizations, where you do internal transactions where there's a transfer of capital property to a taxable Canadian corporation. And as we all know, you can do a rollover of capital property under a T2057 to a taxable Canadian corporation. The 4 considerations with respect to a rollover is fair market value of the capital property, the tax cost of the capital property, i.e. ACB, the elected amount in respect of that capital property, and then the consideration received for the disposition or roll of transfer of that capital property. So the thinking here is that you may have the ability to late file or at least extend the filing deadline. Excuse me, I'll back up. The filing deadline for T2057 is the earlier of the taxpayer's filing deadline. So if it's an individual, it'll be April 30th, 2025. If it's a corporation, taxable Canadian corporation with the year end of December 31, 2024, that would be June 30th, 2025. So we have arguably until April 30th of 2025 to decide what we want to do in respect of triggering a capital gain, if any. And this planning ties in with potentially claiming a capital gains reserve, but also it gives the taxpayer the ability to not necessarily retroactive tax plan, because we would want to make sure that we can effectuate this transaction. So if we had an asset purchase agreement for a disposition of the property on a transfer to a taxable corporation pre-June 25th, 2024, as long as legal counsel, and I'm not a lawyer, as long as legal counsel is aware of the transaction and the intent of the parties, I'm hoping that legal counsel would effectuate that transaction as a date prior to June 25th, 2024, with a closing and effective date on the asset purchase agreement after June 25th, 2024. And as everyone probably knows, you can late file a T2057 with penalties, up to 3 years. I wouldn't suggest we necessarily do that, but we just want to make sure that this type of planning is not considered to be retroactive tax planning. One thing that CRA did come out with was a CRA views doc on May 1st of 2024 that essentially said that any transactions involving taxpayers where they're trying to utilize the 50% inclusion rate rather than the 2/3 proposed inclusion rate would not be subject to GAR. I would suggest you read that CRA views document if you want to get a copy of it. We can certainly post that on our website. But there's further language in the views document in respect of a series of transactions that kind of ties in with capital gain strips, which CRA is suggesting that may be subject to or may be garable, but the actual planning in respect of the 50% inclusion rate in and of itself should not be garable with respect to how CRA views these planning transactions.
So Dell, I think this one provides a lot of flexibility in case, like, let's say, currently the individual holding some sort of business asset, like he could potentially incorporate a corporation, transfer the asset into the corporation, and potentially have the time of flexibility to see how much gain he want to recognize.
Correct.
Yeah, I think this plan is useful whenever the taxpayer know that they may want to recognize the gain, but there was a lot of how do I say it, administrative work that required to get the, let's say, the valuation of the property, and there was probably a hope that the law would never pass or it could be reversed. Then they could potentially use this one. This kind of planning idea, it gives them extra time to see how it goes first. And then, like every other planning idea, there was special consideration for U.S. taxpayer. In this case, if the foreign corporate or the Canadian corporation is controlled by a U.S. taxpayer, any corporate reorganization transaction, they likely going to be taxed differently for U.S. tax purpose versus Canadian tax. For example, U.S. they do not have the flexibility of filing a T2057 and designated a certain agreed amount to trigger the gain. It mostly a measurement in terms of non-common share consideration received by the U.S. taxpayer directly. In the case that the value is over the cost base, then that portion will be recognized as a gain regardless. And also there was some special requirement to file certain gain recognition agreement because now the corporate reorganization provision for the Internal Revenue Code for U.S. tax purpose, there was special requirement for a foreign corporation reorganization, in this case, a Canadian corporation. So I think without going into too much details, I think the key is if our audience thinking about using this strategy and happen to be a U.S. person, there were a lot more kind of consideration have to put into the plan before determining that it's going to be an effective planning idea.
This is an interesting topic. I had a call with a new client yesterday who has made the decision to depart from Canada because he can't stand paying Canadian tax anymore. He's just fed up with it. It was quite a colorful call, to say the least. But you could look at departing Canada, implementing a factual departure from Canada, so you cease to be a resident for Canadian tax purposes. And if you do that prior to June 25th, you're then looking at a deemed disposition of your capital property at fair market value, utilizing a 50% inclusion rate as opposed to the proposed 2/3. You have to go through and look at what are the accrued gains on the types of capital property, and whether certain of those properties can be considered excluded properties. So for example, anything that's real property in Canada is not subject to departure tax. However, if you do have a principal residence or you're planning on keeping that principal residence, you would want to look at electing to have a deemed disposition of that property so that you could claim the principal residence exemption on that property prior to your departure. You'd want to look at the other assets if there's anything that's registered assets, for example, RSPs. Those are not subject to the departure tax rules. You have to look at whether or not that individual has been in Canada for less than 60 months, because departure tax doesn't apply to those individuals resident in Canada less than 60 months. But again, it's proper planning. So ballparking what that estimated tax liability may be on departure, and then determining whether or not you're going to fund that liability, or if you're going to try and post adequate security in respect of that departure tax liability. It should be noted that the adequate security, for example, if you wanted to use equity in your principal residence, as long as the CRA liability and any other encumbrances, for example, mortgages, do not exceed 75% of the value of that property while that departure tax liability exists, that is considered adequate security. And there's no interest charged on that departure tax liability by CRA, because if you immigrate back to Canada post-departure with all of the same assets, the departure tax liability is essentially reversed. But you have to be careful. For example, if you're departing Canada and moving to the US, those assets, unless you do a step up in basis election in the first year in your 1040 as a US resident, if you don't do a step up in basis election, then those assets would be subject to the same tax, capital cost, ACB, for US purposes, even though they've had a deemed disposition for Canadian purposes. So there is a potential for double taxation. So it's important to make sure that you're planning properly. And this last bullet is very important. It's a short time to plan a factual departure and also find a new country of residency. You may have immigration issues if you want to work in that new country of residency. For example, the US, you would have to have some form of a work visa, and that's not going to happen overnight. It certainly won't happen before June 25th, but you can effectuate a factual departure from Canada prior to June 25th, and then go on vacation for a couple of months or 6 months until you get your other residency requirements in order. But it has to be a factual departure, and there's a lot of things that need to be considered in respect of the individual taxpayer with respect to departing from Canada.
Yeah, thanks, Dale. I think this one is more like the last measure that you really know that you are no longer want to be living in Canada. But because this one does involve way more planning than all the other ideas. And with the right facts, this could be a appealing option as well. I think it's just like any other planning idea. You would have to review all the other options, because there is also potential double taxation if you own a private corporation that has appreciated asset inside.
Right.
Then you run into your share got tax once, asset inside of the corporation tax another time. In the case that you want to take out dividend from those corporations, it will be taxed another time. So the proper planning is really the key. Then we move on, last but not least, actually, like I said earlier, this is totally different direction. All the previous planning idea involving recognize the gain some sort of earlier or triggering the gain. This one is just totally the other direction of deferring the gain. Because we know individual has $250,000 threshold. Try to utilize it is key. If possible, let's say if you have investment portfolio large enough, have enough gain on it, you could trigger 250,000 annually and still enjoy the lower inclusion ratio. It plays considering the time value of cash. When do you need the cash? Whether it could be stay invested and keep growing. You hope that the investment return on those assets outweighs kind of the increase in terms of tax. Also, because you're not triggering any gain, so liquidity is not an issue. You don't have to suddenly come up with a few $100,000 to pay tax for the property you gifted to your son. Now you could, let's say, defer it until you pass away, transfer as the estate, and you presumably all the tax you avoid to pay now, they likely going to keep growing bigger and outweigh the increase. And this one also, we as a tax practitioner, we all know that with a law change that is supposed to be effective in such a short period of time, it's tough to consider all the different perspectives related to any planning idea. A lot of times, some planning may be implemented without considering everything. It could potentially backfire and be not achieving what we are hoping for. So by not taking any kind of urgent actions, you avoid running those risks of something that doesn't work out. And then the last but not least is, like Dale has suggested, the history of inclusion ratio has been changed quite a few times over the last 50 years. So you would hope that it could go down, but also there could be kind of double-edged sword that it could potentially even go up to. So nobody knows. That brings us to the next or last final kind of polling questions. So Mr. A is considering gifting his U.S. real property to his son to realize capital gain before June 25th, 2024. Is it a good idea? This one is only yes or no. I think when we set up this question, we try to mostly focus on the tax side, right?
Yeah, we did. And, as you and I were chatting, we thought maybe there should be a third option being maybe, because, as much as Philip and I love tax, we think tax is all things to everyone. There might be other reasons that would enter into the situation or the consideration of whether or not you should gift the real property. So, maybe could be an answer, but from a tax perspective, we went with yes or no. So go ahead, Philip.
Yeah, I think for those paying attention, about 80% of our audience, that is not a good idea for a few different reasons. That the gain on the property would be subject to Canadian tax by Mr. A, and then it will be subject to US tax for his son, and then Miss A, depending on the value of the property, may be still subject to US gift tax. So the quick answer to this question is no, unless you have, let's say, other reason that they'll have alluded to that you may want to consider it. But for simplicity, we just stick to the tax side of the questions. Then we have gone through a lot of different ideas. So what kind of the final thoughts that we have related to this kind of proposed change of capital gain is there was really no one solution that fits all. It really depending on every taxpayer situation, what you want to achieve. You have to consider the age of your the taxpayer, the overall size of the estate, what's the plan, what stage your life you're at right now, whether you have enough cash flow. For example, if the taxpayer is 95 years old and then at terminal illness, now is probably a good time to recognize some of the gain with the consideration that, hey, even we try to defer any capital gain, we are not going to defer it for too long. Now we know that the tax rate is going up. We may just trigger the gain at this moment to save the tax. But on the other end of the spectrum, let's say that you are a successful entrepreneur, that you get a lot of share as a founder, you are in your 30s, you plan to run the business until you are 80s, you have 40, 50 years to defer any of the gain. Likely you may not want to overreact to this proposed change. You have a lot of time to recognize those gains in the future, and potential return on those unpaid tax or tax defer likely going to overweigh any tax increase on the capital gain. The next point is we keep emphasizing that if you have any transaction that you may be subject to foreign tax, you're selling a condo in the US, you happen to be a US person, green card holder, you have to consider the US tax of any foreign tax as well. You don't want to just purely react for just Canadian tax measure, but resulting a total combined tax bill that is even higher than just the increase. We see that a lot that when tax practitioner come up with planning idea, only one country is focused without considering the other side of the story. We talk about it a few times. There was potential reverse and potential decrease for future government. Whenever we talk about politics, your guess is as good as my guess. Nobody knows what would happen in the future. I know there was a lot of hope that maybe potentially there was a new government, they would reverse it. But again, as a tax advisor, I could not know for certain. It's tough for you to factor in those potential reversal or decrease of tax rates. The last point, but actually I think is the most important point, is discuss with your tax advisor to express some of the concern that you have, what's the plan that you have, and then the tax advisor will work with you together come up with the plan. Right now, we are really running against the clock in terms of coming up with any plan that have to be implemented before June 25th. So there should be still enough time. The sooner you could talk to your advisor about any potential plan, any idea you want to achieve, that should give you a good start in terms of try to do anything before June 25th, if you decided to go ahead. So Del, do you have any kind of comments related to this proposed change?
Yeah, I mean, the government has said they're going forward with the implementation on June 25th, regardless of where the proposed bill is in respect of legislation receiving royal assent. There's pushback, like we said at the beginning of the webinar, that CPA Canada is suggesting January 1, 2025. The Joint Committee on Taxation has put out some information on that as well. So there's a lot of groups out there that are suggesting that this is just doesn't work for June 25th timing date. You're going to have to track basis differences going forward. It's now kind of saying to practitioners with CCPCs and investment income, you now have a NERTO and an ERTO type of pool. We'll have similar types of pools, if you will, in respective properties, and watching individuals, trying to time their annual allowance to keep it under $250,000 Canadian. So we have to make sure that if there's any FX issues, that those are considered in that $250,000. So there's a lot of things that need to be considered in proper planning. But I think, your point, Philip, is discuss with your tax advisor, and no one solution fits all taxpayers.
Thank you, Del. So that's brought to the end of our presentation. After that, you will receive a survey. Make sure that you fill it out. Let us know how we can improve and other topic that you would like us to cover. So right now, we would open for a question that was asked during the presentation. And thank you for attending.
Thank you very much.
Well, thank you, Philip and Dale, for this presentation. We do have quite a lot of questions going in. We have quite a few asked about the capital gain reserve. So there is some clarification required. If the reserve is established prior to 2024, for example, if they had a capital gain reserve in 2023, and now they have to include income in 2024 and 2025, would the new inclusion rate apply to the rest of the reserve in 2024 and 2025?
So that's a good question. The school of thought around capital gains reserves is that it's brought into income on the first day of the taxation year. So if we have an existing capital gain reserve in place, I think all that's going to happen is we'll look at the quantum of that reserve that's brought into income in that taxation year. If it's an individual and that inclusion is $250,000 or less, we'd be at 50%. If it's more, then I don't think there's any grandfathering in respect of pre-existing capital gains reserves. That said, we haven't seen the final version of the legislation, so it's just a guess at this point in time. But to me, it would make sense that CRA is going to look at that and say that inclusion was in the 2025 taxation year. If it's in excess of 250, the portion that's in excess of 250,000 would be at 2/3, and the other 200,000 would be at, or sorry, the portion in excess of 250 is at 2/3, and the first 250,000 is at 50%, but we don't know.
And just to add on that, for a corporation, there won't be that 250 exemption.
That's correct. It's only for individuals. So the $250,000 allowance only applies to individuals. It does not apply to corporations or trusts or partnerships, if you will, but partnerships not a taxpayer, but it does not apply to corporations or trusts on or after June 25th, 2024.
And the other question related to that is when the capital gain is realized after the June 25th, 2024 for the capital gain reserve, you still have the first 250,000 as the exemption.
For an individual, that's correct.
Okay, thank you for that.
And that's based on our understanding, but it would be counterintuitive to assume that finance would somehow come back and say, a capital gain reserve, which is available, in your example, an individual would be taxed at, the inclusion rate would be at a different rate than what's allowed in respect of the $250,000 allowance. So it's counterintuitive to think it would be anything else. But again, there's lots of changes to the legislation that has to be implemented when we see the final package, if you will, the Notice of Ways and Means.
Thank you, Dale. So the other question we received is it likely that they will introduce a deemed disposition or reacquisition election rather than forcing the taxpayer to do the actual disposition and then reacquire it?
Can you please reread that again, please?
Is it likely that CRA will reintroduce a deemed disposition or and reacquisition election rather than forcing the taxpayer to actually dispose and then reacquire?
So if this is in the context of, say, departing Canada, where you're deemed to dispose your capital property immediately prior to departure at FMV, it's also in the Act in Section 128.4 that you're also deemed to reacquire that property for FMV. So there's a deemed disposition and a deemed reacquisition already in the legislation in respect of departing Canada. So I'm not sure if that's answering the question properly, but I don't see that there's going to be a requirement to have some form of an election to reacquire the property, because it's just sort of an automatic with a deemed disposition and a reacquisition.
So Sharon, I believe the question more probably whether CRA would introduce a separate deemed disposition and reacquisition specifically related to the capital gain inclusion ratio change.
Right.
It goes back to Dale's previous comment. There are a lot of legislation that haven't been even announced. It's tough to guess whether CRA would introduce that. If there was any gain that you're thinking about potentially try to realize and hoping they would introduce that election, my general recommendation is I would probably try to trigger the actual gain instead of relying on the potential new provision about the election per se. Because by the time it rolls out, it's probably already after June 25th.
Okay.
So we have time for one more question.
Okay, yeah, sounds good. So I think the last question would be what is the estimated break-even time period for the tax deferral to be a better strategy comparing to crystallizing the gain before the June 25th? How long do you have to hold it for?
That's a very good question, and it depends if you look at determining the rate of return on an after-tax basis or a pre-tax basis. And it also is very dependent upon what percent of interest you're using as a discount rate. So I know there was a school of thought out there that suggested if you had a 7% discount rate, looking at the time value of money, that the break-even period was approximately 4 years. But again, there's various factors to consider, but that was just a 4-year period solely based on 50% versus 2/3. It does not consider any types of planning where you can reduce that effective tax rate, for example, using a capital gains reserve. You could accelerate that period of time if you're using a capital gains reserve, but ballpark 4 years.
Thank you, Shannon. And that brought to the end of our presentation. So please make sure that you want to sign up for our upcoming webinar. Next topic would be the Canadian taxation on mountain resident athlete, Tax 101, presented by our partner, Stephen Flynn, and also a director from our collaborating firm in Trowbridge, Brandon. It would be hosted on June 11th. Again, thank you everyone for attending. Hope to see you soon.
Thanks very much. Have a good day.